Hi, and welcome to this morning's early global view. It is Friday, January 22nd, 2016 at 6 a.m. Central U.S. time. We are coming to you just a bit early today because we want this posted up before the important U.S. data that rounds off the week. That would be the manufacturing PMI, existing home sales, and leading indicators. And we, in fact, waited until this morning to see the full impact of what Mario Draghi had to say yesterday at the ECB press conference, along with any influence from Asia. And we'll be momentarily getting to just how strong that has left the equity markets. So we have to ask, what does all this mean to the markets? Well, this morning, again, no further crisis out of Asia, and of course, the oil price having bounded back all the way from down near 26 in expired lead contract February, where the March contract is back up around 30. This is quite an improvement, and it has led to an improved psychology in the equities as well, as the S&P 500 future is up at around 1886, up $25 on the week. Now, the important part of what transpired in the last couple days that we'll see more of on the intermediate and long-term charts is that the failure below 1865 to 60, going back all the way back to Wednesday, was a gap below 1850 previous trading low from last Friday as well, and that chewed right through the support at 1831. The sell-off low from back in August, and 1813, which was the October 2014 Ebola scare low, down to near the psychological support at 1800. Well, on the way back up, though, later on Wednesday, we think probably in anticipation of what the ECB was going to say on Thursday, the market regained all that ground and more, and actually ended up the day back above the 1850, right up in the 1860 to 65 area. Most important, late in the day, it left a fresh up break from just below the 1860 area, which the market held on pullbacks yesterday. So this lack of ability to reinstate the downside momentum presaged what we're seeing today. Of course, the higher resistances are up around 1900, classically, not just psychological, but there's some congestion there, and back up into the 1925 to 32 area that the market could not sustain itself above as we went back out into late week a couple of weeks ago. And that was last week. And that's pretty much it for the short-term view of the S&P 500. And we're going to also head over to the long-term charts once again, and this is the monthly. On here, we're not going to spend too much time discussing this. If you want a further discussion of the whole evolution of the trends up since 2009 and the reaction low in October of 2011, see last weekend's equities and fixed income special weekend edition, where we discussed at length how these trends evolved. But you can see the broader manifestation of that upward channel from the low at 1068 back in October of 2011. That was your breakdown that we pointed out on the weekly chart. You can just see more of the previous channel here on the monthly, the breakdown below the 2015 level. And while it cleaned out above it for a while, October, November, December, coming back down below it reinstated downside momentum. This channel is so important because what we have here is the broadest upward channel since the low back in 2009 at 666. Now, that will be back above it on the close of the week in all likelihood. Probably means that this will be looked at temporarily as a bit of a false signal, and the market can clean up further. But the question is that 1930 or 1960 or upper 19s, or does it fail again pretty quickly? And we're going to have to keep an eye on that, because this is also the important Fibonacci 25% retracement of that whole swing up from the 1068 low in October of 2011. And that pretty much does it for the S&P 500.